Hello, everyone, and welcome to the Town Benefits One Big Beautiful Bill Act for Employers, where we hope to impart some information that you'll find helpful and will, enhance your understanding of how this bill works and what may be out there that you might be interested in as an employer. First, I want to say that Corbin Granger, who is my webinar partner and HR on Mike co-host, was supposed to join us today, and unfortunately, she is not here, so I'm flying solo, so to speak. My name is Barbara Jennings, and I am a human resources consultant with Town Benefits, and I probably know many of the people on the call today because we interact with our clients on a regular basis, and that's one part of our job that both Corbett and I really enjoy. Now, the OBBB Act, there are a number of changes for employers, as I mentioned, and I need to emphasize that what I'm going to present to you today is information that we know today. The bill is, I believe, over 900 pages long. It's complicated, and it's possible that, we're going to get updates. We're going to get some clarification on things. And so I would urge you, listeners, to please keep yourselves up to date, if at all possible, so that you can be, remain informed, because some of these things are just kind of, it's almost like they're just not fleshed out fully and need clarification. So without further delay, let's get started on our presentation. All right, so what are we going to cover today? We are going to cover three main things. First, we're going to talk about the One Big Beautiful Bill Act and specific impacts on employers. Then we're going to talk about some new restrictions on ACA marketplace enrollment. And then we're going to talk about free preventive care and the US Supreme Court. So without further delay, let's get to it. All right, so what is this act all about? Now, specifically, we're going to go into these categories. We're going to talk about changes to health savings accounts. We're going to talk about telehealth exceptions. We're going to talk about dependent care flexible spending accounts, student loans, the new Trump account, tax deductions for overtime pay, and then an employer credit for paid family and medical leave made permanent. And actually, the use of those words made permanent makes me want to clarify something real quick. Some of these things are in existence right now, all right? Some of the things we're going to talk about, and some of them are new. The ones that are in existence now are going to be made permanent or are going to be extended. And then we have others that are brand new ideas and brand new things that you might consider offering to your employees. All right, so first up, let's talk about health savings accounts. You may recall that, gosh, I'm going to say maybe 20 or 25 years ago, a new type of group health plan was created, and it was called a high-deductible health plan. And as you might imagine, these plans had high deductibles, and generally there was a trade-off with a lower premium. So along with the HDHPs, an account called a health savings account, or an HSA, was also created. And what that did was it enabled participants to set aside money to be used to generally pay the out-of-pocket costs that they would incur with their HDHP. And generally speaking, except for preventive services, these accounts and the HDHP, you had to meet your entire deductible before the plan would start paying. And so that meant that your out-of-pocket costs may be higher, which is, again, why they created these accounts. And so the fact now they're making some changes and tweaking these to make them easier to use, the first way that they're doing that is through direct primary care arrangements and the reimbursement for those fees. Now, a direct primary care arrangement is something that's also called sometimes a boutique medical practice. And what the deal is that a doctor or a group of doctors will offer this plan to their patients, and you pay a monthly subscription fee. And in exchange for that, you may get additional benefits through your medical practice, which might be like a same-day appointment, or you might be able to spend more time with your doctor, or whatever, however the plan is designed. But the bottom line for us today is that you were never able to pay for those monthly prescription fees out of your health savings account. Now you will be able to be reimbursed up to $150 a month for an individual and up to $300 a month for a family for those subscription fees. So that's number one kind of expansion of use of HSA money. Okay, then the second thing that is probably not going to affect you as an employer, but it could affect some employees, I suppose. Under the ACA marketplace, there are high deductible health plans that are available that can work with HSAs, but the powers that be are expanding the definition of a high deductible health plan to include all bronze plans and catastrophic plans that are available on the ACA marketplace. And so automatically bronze, catastrophic are going to become high deductible plans. And what that means is that participants will be able to set aside money under a health savings account if they are enrolled in one of those plans. So I think the purpose of this is to sort of expand the use of health savings accounts. So that's going to take effect on January 1st of 2026. All right, then the next topic that we're going to talk about is going to be a telehealth exception. Now, telehealth became more popular during COVID when, if you recall, during COVID, people tended to want to avoid going to a doctor's office. And so at that point, they expanded the telehealth medicine and they made it possible to have those charges paid for outside of the deductible if you had a high deductible health plan. And so normally, as I said before, you have to meet that whole high deductible before the plan starts paying. But now for telehealth visits, you're going to be able to do those visits, or you have been able to. This is an extension of that. So it technically expired as of 12/31 of 24. So they've sort of retroactively reinstated that telehealth exception back to 1/1 of 25. So that's another thing that you might want to be aware of. And if you have a high deductible plan, to let your employees know that's being expanded. All right, next is increase in the dollar amount you can set aside in a dependent care flexible spending account. And this really should be good news to your employees who are parents and have children in daycare. Since these accounts came into being, I believe it was in 1988, you've only been able to put $5,000 a year in there on a tax favored basis. And now finally, they have decided to increase that to $7,500. So like I say, that could be a welcome change for a lot of parents. And if you are married filing jointly, or if you're a single individual, you may be able to take up to the full $7,500. If you're married filing separately, you're going to be limited to $3,650. Now, as an employer, you may need to amend your plan document to provide for the $7,500. And by the way, this is not something that's mandatory. You don't have to allow the full $7,500, but if you want to, you should check with your plan administrator about increasing that in your plan document. Now, some of these things as we go along, you're going to hear and see that they're going to be inflation adjusted over the years, and some are not going to be inflation adjusted. And this is one of the nots. This is one of those that will not be adjusted for inflation. And I guess the fact that it took nearly 40 years to go from 5,000 to 7,500, that's not an unexpected feature. All right, now next up, we have education assistance programs and student loans, student loan repayment. Now, this is something that has been in place for a while, but what is happening is this is going to be made permanent, and also it may, I'm not sure about this, it may be expanding the use of the tax favored dollars. So what you can do as an employer is you can contribute $5,250 up to that amount per employee per year in tax-free benefits for educational assistance. Now, this can be used for books, equipment, supplies, tuition, and other types of fees. And it can also be used for principal and interest on employee student loans. So if you want to put this in place, you and your employee can work out how the money is to be allocated, like if they would want the whole chunk to go to their student loans, or if they would want to pay current tuition and that sort of thing. And it can be made payable, either you can pay directly to the lender, or you can pay the employee to use to pay the lender. Now, if you do this, you need to have a written document, and also you cannot discriminate in favor of highly compensated employees. So this has to be something that's available to everyone, or you may be able to distinguish between classes of employees like full-time and part-time, but in any case, you cannot discriminate in favor of highly compensated people. Now, I think a lot of large employers may be utilizing this as a benefit, and maybe as a small employer, you might want to consider it. I know that this is one of those things that could be a useful retention tool and recruiting tool. If new employees know that you've got this available, that could help you be competitive in a marketplace that might be, a competitive marketplace for the folks you're trying to keep and you're trying to attract. This is going to be one that is going to be subject to inflation adjustment each year. All right, now here's a brand new kid on the block, so to speak. This is the new, what they call the Trump accounts, and this is effective in 2026. Trump accounts are a lot like IRAs, and it's a way of setting aside money, and in this case, up to $5,000 per year per child under age 18. And the earnings are going to grow tax deferred. Now, where do you come in as the employer? Well, the employer is able to put $2,500 of that $5,000 per year into this account. And again, this could be another one of those recruiting and retention tools that you could decide you want to go ahead and fund that $2,500 for people who have children under age 18. And there's a little special benefit here for children who are born between 2025 and 2028. And that is that all those children, and they do have to be citizens, they may be eligible to receive a special $1,000 contribution from the federal government, but that is restricted to children born 2025 through 2028. These accounts in general are not restricted to children just born those years, but that $1,000 kind of like seed money does have that restriction. Now, if you decide you're going to do this as an employer, then you need to create a written plan document, and then you also have to do annual non-discrimination testing, and you have to do employee notifications. Now, I don't know any details about this, and I don't know that details are out there yet. So this is going to be one of those things that we expect to hear more in the future. For example, I know that there are restrictions on where this money can be invested, and I don't know the details about those restrictions. So these things are going to be hopefully revealed to us as the months go by. This is another one that may be inflation adjusted beginning in 2027. Now, here's another one that this truly could be a big benefit to your employees, and this is the tax deductibility of overtime pay. And the way that works is, number one, your employees who work overtime would be able to take a tax deduction for overtime income. That tax deduction would be $12,500 per year for an individual, or up to $25,000 if married and filing jointly. And the way the calculation works is this: it would be for hours worked beyond 40 hours in a work week, and it would only be for that premium rate, that time and a half rate. So that is the Fair Labor Standards Act definition of overtime, the premium rate of time and a half for hours worked beyond 40. So if you have employees that make, just say, $10 an hour, their overtime premium rate would be $15 an hour, and they would be able to take the deduction for that $5 an hour premium rate. Now, here's the kicker, though. This may be disappointing to some employees, but in the end, it will work out okay. But in any case, this overtime money is going to be paid to the employees just like normal. So every payday that they've worked overtime, they're going to see the overtime pay in their paycheck, which means that it's going to be subject to regular income taxes. But when it comes time to file for their taxes, that is the point at which they can total their income, their overtime income for the entire year, and then take the $12,500 or the $25,000 off of their taxes at that point. And they do not have to be people who itemize their deductions. This is what's called an above the line deduction, which means when you're doing your taxes, it's deducted early on the tax form. I don't think there have been any tax forms created yet for the 2025 tax year. And so you just gotta have to envision what that's likely to look like. Now, from the employer point of view, this means that the income is going to be that premium overtime income is going to have to appear separately on the W-2 form. So I feel sure that IRS employees are scurrying around right now trying to redesign the W-2s so that they can conform to what this benefit requires. And it remains to be seen when that's going to be released, when we'll see what that new W-2 form looks like. Your payroll providers and your third-party administrators are often very good sources of information on these changes, and so you might just keep in touch with those two entities to find out more specific information about this. Now, these exemptions are only going to apply from tax years 25 through 28. And what that means is for 2025, because right now you're not segregating this premium overtime on your employees' pay records, somehow they're going to have to come up with a plan to enable, whether it's going to be estimates, whether you're going to be required to go back and do calculations. That remains to be seen. I do not know that those details have been worked out yet. But as we've seen with many of these laws, they do sometimes get extended, but right now we are just looking at tax years 25 through 28. All right, now here's another one that you as the employer may benefit from, and that is there is a paid family leave credit that's out there, and it has been out there for several years, and I don't know personally how many employers are utilizing this credit, but here's the way it works. You know that there are different forms of paid leave that employees can take. In order to be subject to the tax credit, this family and medical leave program has got to be a program that is in addition to the regular PTO, vacation sick leave bank and all that sort of thing. It has to be created specifically in order to satisfy this credit, basically. And the minimal requirements are that you offer your employees at least 2 weeks of pay at a rate of at least 50% of the employee's pay to use for paid family and medical leave. So that's a specific plan and program designed just for this purpose. Now, this is going to be one of those things where you might want to work with your tax advisor to talk about exactly how this might benefit you, because that 50% of employee pay, I believe that gets you a 12.5% tax credit. But the more you pay the employee, the more your tax credit can be. So let's say you bump that up to 60% of your employee's pay, then that means your credit will also increase. So that's some things to keep in mind. Now, right now, it's for employees that have been there for 1 year. And going forward, it will be for employees who've been with you for 6 months. Excuse me. Now, you have to have a written policy for this, and it has to apply 50% of regular wages. Let's see. I'm sorry, I'm reading a note here. No, I'm sorry, never mind that one. It does require a written policy in order for you to be able to use this. So hopefully some employers can take advantage of that, honestly. All right, now we're going to talk about some restrictions on ACA marketplace enrollment. And as an employer, a lot of this might not apply to you, but it's good to know about. So on June 25th of 2025, HHS published a final rule to implement new marketplace standards. And many of these rules are effective 60 days after its publication, which would mean August 25th of 2025, although some of these are going to be later because they had to do with plan years. Some of them also sunset at the end of one plan year. So let's see, what are the details here? All right, first of all, people whose household incomes are below 150% of the federal poverty level have kind of this standing special enrollment period to go into and out of the ACA marketplace. Well, that is going to go away for whatever reason during the 2026 plan year. So what that means is that people at below the 150% of the federal poverty level are going to have to conform to the standard marketplace open enrollment period. And the next bullet point talks about that open enrollment period actually is going to change for the open enrollment period starting in 2027. And so that would mean that at the end of 2026, you'll start seeing publications that address the new open enrollment period. So now open enrollment periods for the marketplace must start no later than December 1st, and they must end no later than December 31st, and cannot be for more than 9 calendar weeks. So for exchanges on the federal platform, this change will be in effect beginning plan year 2027, where the new open enrollment period will run from November 1st through December 15th, preceding that 2027 coverage year. So the next thing, and I think that it's possible that this could affect some employers, but I don't know, I guess that remains to be seen. You may remember that there's a group of people, it's a pretty sizable group of people out there in the US who were brought here illegally as children, and they have been granted a status called the Deferred Action for Childhood Arrivals, which is we call DACA. Well, right now, DACA recipients are able to enroll through the marketplace, but beginning in 2026, DACA recipients will not be able to enroll in marketplace plans. So, you know, I guess it's conceivable, especially for very small employers, that if somebody is in that boat, they may want to join your plan when they lose their coverage through the marketplace. All right, next we have the issue of advanced premium tax credits. You are probably aware that many people who fall below certain income thresholds receive a tax credit against their marketplace plan premiums. Supposedly, people have been required to reconcile at the end of each year, did they get the right amount of premium tax credit? Did they get too little, too much, and that sort of thing? And what they're starting as of 2026, and my most recent information says for the 2026 plan year only, and again, I'm not sure why that would be. So that's one of those things that I and anyone else who wants to know about this should keep their eyes open for. So what they're doing here is if people have not reconciled their premium tax credit from a previous year or filed their tax return, they are not going to be allowed to re-enroll for the upcoming plan year. All right, next bullet point, they are going to allow insurers to require that all past due payments be brought up to date before making new coverage effective for people on the marketplace. And again, this may be hindered by state law, but for right now, that's going to be the federal law. Next bullet point is requiring individuals who are automatically renewed in coverage through a federal platform exchange with zero premium, they are going to charge them $5 a month until they confirm their eligibility information. So they basically can't re-enroll, or I'm sorry, they basically have to pay $5 until they send in any other documentation that's needed that confirms what their income is. Yeah, sorry, some of these details get mixed up. So next is prohibiting issuers of non-grandfathered individual and small group market plans from covering specified sex trait modification procedures as essential health benefits. So there may be people who lose some coverage based on this new rule that these surgeries cannot be considered essential health benefits. And actually, it's not just surgeries, it's also other procedures as well. So that's going to be beginning in the plan year that starts in January 1 of 2026. And again, as I said, that's not likely to impact, none of that's likely to impact a lot of employers, but it's good to know that those changes are out there. I mean, who knows, you could have family members who want to know this information as well. All right, so then finally, we're going to talk just briefly about the ACA preventive care and the US Supreme Court. And I'm not sure I will go over all of these slides. I think it's only 2 actually, but anyway, so what happened? A while back in 2025, an employer group sued the government because they felt that there were things on the list of preventive health care that was mandated to be covered that not all those things were appropriate to be covered as free preventive care. And so they sued, and actually the Supreme Court ruled against that employer group and maintained this list of preventive care and did mandate, again, the continuation of the preventive care services. So this next slide is just some information on if anyone's ever wondered what's on that list and why. And just briefly to talk about the items on the list are items and services that are A or B rated as recommendations of the US Preventive Services Task Force. And that A and B list basically sorts into 2 types of preventive services. The A list would be those services that are or have been proven objectively to help prevent illness or injury and that sort of thing. And the B list is things that may be helpful for people, but that are not at this point actually proven to prevent injury or illness. So for example, A list items would be colonoscopies for people over 50, would be mammograms for women over a certain age. Those have been proven scientifically to help prevent harm, basically. The B-rated list is things that are not that strong, but that still are helpful to patients. An example would be if you're over 65, I think, or maybe even be over 60, your primary care doctor may start reviewing a list of items that you might consider, like, have you been having bouts of depression? How is your social life? Do you have friends? Are you active, and that sort of thing? Those are still on the list as covered preventive services, but those have not been proven to be associated with the prevention of illness. But it might be worth knowing this. Immunizations for pretty much everyone are on the list of things that have been proven to prevent harm. Evidence-informed preventive care screenings as supported by Health and Human Services, those are still on the list. And then some other things that pertain to infants, children, and adolescents. So that right now, those preventive care services are going to remain covered. And that could change, but for the moment, they're still covered. All right, and that wraps up what we are here to do today. And I want to thank you for joining us. And I want to, again, reiterate that Corbin and I very much enjoy our client interactions. And we hope that you'll feel free to contact us if you have any questions or would like to just discuss a scenario. We're always happy to have contact with our clients. Thank you so much and have a good rest of your day.